But if there's a strong job market, there's no need to cut interest rates. Having a low number as far as employment in this last report kind of showed where the economy really is. All the stars are aligning for the Fed to cut again, right in line to where we were last year. And last year it wasn't pretty.
I'm Karl Kyler. We're back with Matt.Kish from Movement Mortgage. We had a lot go on these last 2 weeks. Matt.Kish is going to fill us in on all those details to update you with exactly where the mortgage market is. Matt, right now we have rates that are at the lowest level, I think, since January. Is that right?
Yeah, they're getting lower, they're getting better. This week has they've trickled a little bit upward, but we really got some good movement in the bond market. We really got some positive gains, hoping to capitalize still on these gains. We're locking in refinances. We're talking to our people out there and letting them know, like, hey, these rates are coming down. Are you in the position where you would like to refinance? And also, hey, those on the couch, we're in the position that you were waiting for. Are you ready to get off the couch and back into the game? So we're really set up nicely. We'll just hope that this trend continues. Like we've been talking about for a couple months now, all it takes is a day or two of bad news and it could really sway these markets. Again, we've really showed great gains. Like you said, rates are at their lowest they've been in a long time. And we're hoping that that trend continues. The data will show and time will tell, but we're set up nicely as we sit today.
Yeah, I'm hoping with the Fannie Mae rate forecast that they dropped, I think they dropped it probably a week or two ago. They estimated mortgage interest rates would be around 6.4 by the end of the year and 6 flat by the end of 2026. And then this happened, right? Which we'll talk about why this happened in a second, but I'm hoping that this will be the catalyst that will really put us on track to hit that forecast that they had at that 6.4-ish that we talked about 2 weeks ago. So let's jump into why the chaos in mortgage rates. So we had just in a blink of an eye, over 250,000 jobs disappear. The Labor Bureau, how was it?
Bureau of Labor Statistics.
Thank you. Bureau of Labor Statistics, the head got fired because of horrible reporting. And can you fill us in on the details? Like what happened exactly? It sounds like Trump put a new head in, and it sounds like they're going to, we need better data from the Bureau of Labor Statistics. So we can't just have 250,000 jobs disappear out of nowhere because they collected inaccurate data or not enough data, or they were predicting different data. So what is it we need to change? If you can give us an update on what happened in the BLS, and then also what can we expect to change on their jobs reporting that might influence the labor market and the future of the economy?
So, easy short answer is they got to get modernized, right? Like they got to jump into the 21st century. A lot of the data and a lot of the information that the BLS gets is still like survey driven, like household surveys and things pre-pandemic even. So a lot of the numbers and just the way they collect these numbers are already kind of obsolete, right? And we've seen it, and we actually talked about it. You rewind the tape a couple months, is we talked about how the BLS has got it wrong month after month. And, in no other occupation could you be that wrong and keep your job. Well, here we are. This person had been wrong historically, and they lost their job. But the weird part is they lost their job when I believe in kind of the data shows that they finally got it right. And so we're kind of in this quandary. We don't know what's going to happen with the numbers. We don't know how going forward they're going to collect the data. Are they going to, modernize? Are they going to do it the right way? Or is this kind of going to get politicized? And we don't know, because the BLS has to remain independent. There has to be firewalls to keep them independent and not politicized. So as far as where the direction of the BLS is going, hopefully it still stays independent, right? But as far as what could they do to better get the numbers our way and make sure that the data is correct the first time they report these numbers is, like I just talked about, they have to get modernized. Instead of doing these surveys, they need to get in touch with the employers. The employers have to take part in these surveys. And not only the employers is the paid companies, Paychecks, ADP, the folks that produce your paychecks have to get involved in these surveys as well. That'll tell us who's really getting paid part-time versus full-time as well. That has to be broken down. So there's a lot of factors that go into this data, and all of it is 1990s, 1980s, the way they collect it. So got to get modernized, the way they collect the data. They can't be revising these big numbers because that's going to erode confidence in any report that they come out with. January, February, March, all the way through June, every single report got revised. Hundreds of thousands of jobs pulled out of these reports. So you can't really give anybody confidence in your reporting if every month you're changing the report, right? And that's the only way to really do that is to change your metrics and how you collect these data points and how we're going out there and really reporting it.
With that being said, can you help us understand? So like I mentioned earlier, 250,000 jobs disappeared in the revision. What did that do to the market exactly that caused interest rates to come down?
Well, the unemployment rate, right, is going to be one of the factors that's going to drive these mortgage rates up or down. So more people collecting unemployment, less people in the workforce, a smaller economy is going to cause for the government and the Fed to take their foot off the brakes a little bit, to give a little easing back to the folks that are struggling, leaving the job market, losing their jobs, losing their benefits, losing their retirements, things of that nature. Easing of the rates helps them kind of combat losing their jobs. But if there's a strong job market, there's no need to cut interest rates, right? So with every month, like I said, from January to June, we were trending the right way as far as interest rates were concerned. Then this BLS number would come out. We would get kicked in the pants as far as interest rates because the job numbers were so strong, and then it would take a whole month to recoup these numbers in the BLS as far as rates were concerned. So having a low number as far as employment in this last report kind of showed where the economy really is and caused for interest rates to kind of tick down, because it kind of shows like, hey, these folks may need a little bit of help out there.
So let me see if I can, just based on what I've learned with you over these talks, the job revision so vast made consumer confidence a little more concerning, right? And that led consumers, investors, such and such, to move their money from the stock market into maybe bonds, where it's a little bit safer, guaranteed or whatnot, forced the 10-year treasury down, thus mortgage rates came down too. Is that kind of close?
It's kind of close. There's more factors obviously than that, but that's exactly it. It's a weaker economy is going to trigger lower interest rates. It's not side by side, but as you look at any graph, you'll see it follows directly, right? As the economy slows down, interest rates, get a little bit lower. As the economy cranks back up, interest rates get higher. It's just the ebb and flow of the way the economy works, right? As you saw a weak job report, you saw rates kind of follow that. As you've seen with strong job reports, rates really follow that January through June. And like we talked about, especially if you rewind the tape into our conversations in April and May, like, wow, these numbers are being revised heavily, and wow, these numbers are just way wrong. We got to do something about it. Seems like they kind of did something about it, and then it was called for a change. So it's scary to think that these numbers could be politicized. Again, I really hope there's firewalls instilled with this new management, whoever becomes the head of the BLS. I hope they really make it a point to keep it an independent company, but also integrate modernization of this data collecting and really revamp and give confidence to consumers out there what is really happening in this economy, right? So we got to get these numbers right. We got to get the report close to right the first time it comes out, because we can't revising it down 90% month after month.
Agreed. We definitely need that data collection updated, and why they're lagging on that is beyond me, but regardless. So hopefully the BLS will move in a direction a little bit more modern and continue to stay independent from politics, because I can see where that could get a little scary. Here we have a president that wants, really, really great unemployment, at the same time, lower mortgage rates, and those two things don't really go side by side. So I guess we'll just cross that bridge as we see it happen. But let's go ahead and just move into, let's talk about rates. So we're really, really close to that 6.5 number. And what I'm wondering is this enough? Is 6.5-ish, I'll say that very loosely, is 6.5-ish enough to kind of pull us out of this little bit of a funk that we're in, at least here in Southern California?
I mean, short answer is yes. Every little bit helps, right? If you're going from 7 to 6.5 or 6.5 to 6, I mean, obviously, depending on your loan amount, if you have a $100,000 loan amount, it might not really sway the pendulum much. But if you have $1 million loan amount, it's really, really going to help out a lot, right? So if you have a $1 million loan amount, the difference between a half a point, it's going to be, $500, right? And that's a huge chunk of change when you start breaking down $500 month after month after month. Yes, every little bit helps. The difference between 7 and 6.5 is huge. The difference between 7 and 6 is gigantic. But man, even a quarter of a percent, right? If you have a $2 million loan amount, just do the math. A quarter of a point all the way down really, really, really helps. So from 7 to 6.5, yeah, tremendous help. From 6.5 to 6, you're going to see a lot of competition out there, just because how much lower can it go after 6, right? All things considered, no pandemics or nothing funky out there in the world. Interest rates are going to be living right around where they are. So it's going to help out a lot every half a point down. But yeah, it's a big difference between 7 and 6.5, I would say.
Yeah, I as I'm out there in the field working with buyers pretty regularly and having these conversations, especially as people that come through my open houses, that rate sensitivity is just so high, especially considering the uncertainty around homeowners insurance, right? So I had a client I met with last week in Rancho Bernardo in a condo, and her homeowner's insurance is like $140 a month or $150 a month in a condo, which is crazy. And then her HOAs are $700 a month because the HOA has a hard time managing homeowner's insurance for the whole complex. And so it's like this half point difference seems like it would soften buyers who are just really, really close. What I'm really interested in to know, and maybe you could just give us your personal insights, if we got to 6%, do you think that would be enough to kind of stir the market back up into like the June numbers in San Diego reported all negative growth on pricing? So if we got down to under 6.5, somewhere close to 6 maybe, would that be enough, do you think, to stir buyer demand up to where it I'm going to use seller's market very loosely because I don't want to go into an extreme of what we experienced in the early 2020s, but would it put us back into a seller's market where we're seeing positive growth on price? Do you think that would be enough?
Enough? I would hope so. Again, we know there's no sign that they're going to get much lower than that. And we just talked about the half a point swing, especially you're talking about Rancho Bernardo, right? Perfect example. Even a condo in Rancho Bernardo is probably going to be going close to $1 million, right? So, and you just talked about a $700 HOA. Well, there it is right there. You just saved your HOA every month by switching from 7% to 6% in that loan amount up in Rancho Bernardo, right? So, man, that's a huge difference. if now you could get in there and you could afford that HOA, regardless of what your homeowner's insurance is, knowing that you just saved on that HOA just by the rates lowering 1%, that's huge.
Yeah, what a great example of context there. Like if the rates came down, you could literally offset your HOA. So that really puts things into a chewable context. Last question. So the unemployment market is radically off. The labor data revisions came after the Fed announced holding the Fed funds rate. And we know that the Fed funds rate is a influencer of short-term rates. And then there's like these indirect effects that kind of bleed into long-term rates, which would be mortgages. If the Fed come this September, do something a little more aggressive with a Fed funds rate cut, because it seems like everyone's like, okay, they have what they need. Like our labor data is not strong enough. If they happen to do more of an aggressive rate cut, Fed Chair Waller is for 1.5 cut. If we did something aggressive, maybe not 1.5, but like a full point or something, like, is that, what kind of influence do you think that could have on the mortgage side of the market?
Well, not so quite yet. Fed Chair Waller wants to cut rates, and there's a lot of members of the Fed that wants to cut rates, and there's Waller wanted to cut rates last month. So there is calls, and the data kind of shows, hey, this, when you cut rates last September, October, this is where the data was, and we're pretty much along those lines. Again, the Fed chair came out and said, we want to see what the tariffs do, kind of forward thinking, and everybody was kind of up in awe with that because he's been so, looking in the rearview mirror as far as his data is concerned. But what it might do, the only thing I could use is my experience and what happened last time, and it wasn't pretty as far as mortgage rates were concerned, right? I'm hoping that any cut with the Fed fund rate has a positive influence on the bond market and what that does to mortgage interest rates. But again, we were set up for this last year, and we're the scholastics and all of the graphs that I look at on a daily basis are pretty much lined up to where we were last year at this time, weirdly. And all the stars are aligning for the Fed to cut again, right in line to where we were last year. And last year it wasn't pretty. So I would be remiss if I didn't tell you I was very, very pessimistic when it comes to what's going to happen with mortgage interest rates when the Fed decides to cut, because of what's going on with the BLS, and we might see a different job number side by side with these interest rate cuts. So again, I'm advising folks to lock in right now, given the data is pretty much online with where we were last year. But it could be good, it could be bad. I wish I was better than 50-50, right? But it's been a very diabolic kind of 8 months as far as policy. We really don't have any policy or anything on the tracks to move us forward confidently. So it's cardiac. We really don't know, and we just hope it's going to be good. But we hoped it was going to be good last year, and it really snake bit us. So I'm pessimistic this first cut.
Very fair. I think I'm in the same boat as you based on what we've talked about over the last however many months that we've been doing this. The fact that we cut rates last year and mortgage rates went up. It's not something a lot of people are betting that, oh, when federal fund rate cuts rates, mortgage rates are going to come down. And I'm like, that's a big bet you're making, especially when rates have come down aggressively so much right now. Like lock in now, and then if they happen to come down, just refi then. But like, let's look at your payment now, see what your affordability factors are and how they align, and see what you can do now rather than trying to roll your dice on something like that.
Right, and like you kind of pointed light on a second ago, is you can't have these great employment numbers and also cut rates. It's just not conducive to the way the economy works. So you can't have both. You can't have your cake and eat it too there. So I'm very interested to see what's going to happen. But if the job numbers are strong, why would the Fed be interested in lowering any rate? And that's kind of my concern. So if we get a strong job numbers and the Fed fund rates cuts, the banks and what the banks lend to themselves, home equity lines of credit, your credit cards, auto loans, those are all going to get a little better for you for sure. But as far as the 10-year note, as far as mortgage rates directly being influenced by it positively, I'm not so optimistic.
I'm in that same boat with you, Kish. So let's go ahead and call it a wrap there. Thanks for joining us. If you are interested in getting a refi, or if you're looking at buying, you want to explore your options, I got Kish's contact info in the comment section, or not the comment section, but the description of this video, that section below. So you can contact him directly by his numbers there, as well as his email. Kish, do you have any last comments or thoughts you want to leave the audience?
Just be cool to each other, be nice out there, and give us a shout if you need anything.
Always good advice. As always, I'm Karl Kyler, your San Diego Realtor. I'll see you in the next video.